Alright guys, this is Austin coming back to you with the business strategy game year 19 decisions. So you guys should already have been able to take a look at the year 19 first look, which is going to alert you to what the situation is. If you haven't seen it, go back and check that video. That way you'll be able to understand what the decisions really were. But this year was crazy. Just a lot of stuff going on as far as just decisions to make. These are critical decisions. So let's take a look at what we're really talking about here. Now, we sat down with the team, Stephen Curtis and myself, and tried to figure out what we need to do. Now, this is a simulation about running a shoe company and all the decisions that have to go into that. But at the end of the day, this is a game. So all the decisions up to now were about running a shoe company, and now we're talking about how to win the game. Now, this is similar to, at least in my mind, it's similar to games like Civilization. And I say that because in Civilization, you're creating a, civilization, and you have to figure out about, your military presence and your economy and getting technological advancements and progressing through the ages, etc. But at the end of the day, you've got to figure out how you're going to win the game, and there are a number of different victory conditions, from world domination through military, to economic domination, to a cultural victory. There's just lots of different ways to do that. Now, in this game, it's a little different. This game is all about your business. So how do you win? Basically, the way that we understand it, your score is going to come from a combined total of your image, your credit rating, your stock price, your return on equity, and your earnings per share. Here it is, the best in industry score. Boom. So you can get 20 points for each. And that's going to separate us from the other companies. There are also bonuses that you can get. So bonuses can boost you past, we have cumulative, bonus points being given. So bonuses can put you past 100 points, but that's really what the scoreboard's about. The scoreboard is about those 5 criteria. So we had to figure out how to maximize those 5 criteria. Now, image is based off of your corporate citizenship and your sales. I mean, obviously, when you sell more shoes, you've got a better image. Also, if you can hit these corporate social responsibility marks, you can do that as well. It looks like Cart Company took that for year 18, and then every previous year, it's been the BZs. Now, when it comes down to your credit rating, that has to do with your financials. So that has to do, with your finance and cash flow, and how much money you're borrowing, and all those other things. Let's see, if we go down to our balance sheet and cash flow, and talk about our liabilities, and how many outstanding loans we have, and our total liabilities being $286 million, and we're about to double that, so we're about to have some serious liabilities. But that's, that just is what it is. So we understand credit rating, we understand image. Now, earnings per share, return on equity, and stock price. Earnings per share has to do with the amount of money that you're earning compared to how many outstanding shares you have. Your return on equity and earnings per share are linked in the sense that the amount that you're doing as far as business is going to affect those two numbers. Your stock price is a little more volatile. If you want to look at our stock price, we can take a look at that. But the stock price is a little more unpredictable. What we've been able to understand about your stock price is that's going to rise if your earnings per share, if your return on equity is rising, then your stock price should be rising. As you can see, what happened to us in year 16, we had an increase in return on equity and an increase in stock price. Then we had a decrease in return on equity. Our return on equity is still good. I mean, it's good. So we still had a good stock price, but it went down. And then we had a gain in return on equity, and our stock price shot way up. So, I mean, investor sentiment affects your stock price, and that's going to be based on return on equity, basically fundamentals. But there are some technicals in there, and that has to do. Well, I can't say technicals. Never mind. There is some more nuanced aspects of sentiment that we're trying to figure out. The player's guide says that in the event that you are giving dividends, that can affect your stock price, and I don't think we've been doing that actually. We're set to do that this year. So we're trying to stabilize our stock price a little bit in order to win the game. But I don't know how that's going to work. If you've been watching the previous years, you've been able to see that we thought celebrity endorsements was going to be a huge deal, and it really wasn't. So Cart Company stole all of the celebrities, and then they didn't do that. Let me not say they didn't do great, but they raised their price and lost market share, even though they had all the celebrities. So it didn't work out too well in their favor. So there are a lot of things in the game that we know have an effect. We just don't know how much of an effect they're going to have, and because of that, we're just experimenting. Your guess is as good as ours. So when it comes down to year 19, what did we decide to do? Now here's the real question. Hang on one second while I pull up a few of the things. I'll be right back. All right, I'm back. So here's the deal. We made a play for Latin America, and we lowered our price. We had our price very, very low for a number of years. And we gained a lot of market share in Latin America. We really took it to task and tried to become the market leaders in Latin America, and it looks like we have won that battle. The tough part is that this year, winning that battle is not necessarily our best situation for this year. And I say that because when it comes to our projections for year 19, we are not projecting to be doing too well in Latin America because of an adjustment from exchange rate, the exchange rate adjustment. That is, I'm trying to find that for you guys. Here it is. Okay, so what we're seeing here in Latin America is that because of exchange rates this year, we're looking at having an exchange rate adjustment of negative $5.63, which really makes it difficult for us to keep our previous pricing in Latin America. So we have had to increase the price of our shoes in Latin America, which is most likely going to cost us market share. But we had to do that to maintain some level of profitability. We're hoping that we have some customer loyalty, and that will allow us to get through this year so we can come back next year strong. But yeah, I mean, we have to raise prices in Latin America in order to overcome this exchange rate adjustment. Now we're increasing the price in Latin America a little bit more than just the amount of the exchange rate adjustment, and that's because we just need to be able to get to a level of profitability in Latin America that makes sense for us moving into the final years, especially when it comes to return on equity and your that other measure. Why can't I remember what it is? And earnings per share, that thing. So so what are we gonna do? That's what you're gonna find out. So we are raising our prices in Latin America. That's important. We're actually we're lowering our marketing spend in Latin America. That's important. I don't know if we're going to keep it low. We actually may bump that back up a little bit. But either way you look at it. So we're really dropping a lot of market share in Latin America. It's kind of freeing us up a little bit to pursue some other opportunities. We're kind of leveling the playing field here as far as how much market share we're going to take and how much market share we're going to eat up. We just want to make sure that market share is profitable, so we're going to be increasing our prices to make sure that the market share we retain is more profitable. Even if it costs us in net revenue, it's going to free up some capacity this year. Then once we have our capacity online next year, we can really start driving our prices back down, gaining this market share back, making sure that it's overall profitable for us, and also taking control of the private label market. So that's really our plan. As you can see, we're really selling at cost in North America this year. We really want to be able to just kind of shut that market down and then seek profits in these other markets here. We're assuming that we're not going to get the bid in Latin America. We're assuming that other countries are going to come in here and kind of bid us out of that. But if we do get it, that would be perfect for us. That would really put us in a very good position. But yeah, I mean, really the way that we see it is that the other companies. So what really drove our decision was the fact that when we're looking at the other companies and what they can do, right? It's really coming down to where the market is growing and the capacity that the other companies have. No one built capacity in year 18, which would have been a great time to build it. The BZs do have more capacity than us. That gives us more options. That gives them more options than us. And if they don't build capacity this year, it would really have been a dogfight between our two companies. We decided to build capacity, and the reason why we decided to build capacity is because if we are the capacity leaders coming into year 20, we can dictate what happens to the market. And let me explain how that works. So, my spreadsheets are so ugly. My teammate Steve, he has beautiful Excel sheets. They're just gorgeous. Mine are kind of hideous in comparison, but they get the job done. So what we're looking at here, if we're looking at the this is for the BZs here. So the BZs, based off of just their market share from last year, if they maintain their market share from last year, which I think their market share will most likely grow because ours is going to shrink, so that's going to suck up more of their capacity. But if we just keep what they have from last year, next year they're going to have the ability to take over 75% of the private label market, and the year after that just 61%. Okay, so they're just not going to have the capacity to be able to meet their already held market share and to be able to control the private label market. But if they did build capacity this year, that means that we would be the ones that were even further in that position of not being able to cover everything, right? Now, Cart Company, if they don't build capacity this year, they can only cover 19% of the private label market this year. Well, that's for sure. If they keep all of their previous market shares and then they don't grow at all, which is best case scenario for private label, that means they can only cover 19% of the private label market. It is what it is. So any growth in any other market is going to further reduce their ability to gain market share in private label. And if we combine the two together, we're talking about a total this year of what, 94%. So they can, if they both go into the private label market and they kind of spread out to make sure that we don't get anything, they can cover 94%. I don't think it's going to happen, but they can do that. I think there's no cannibalization, and they work together. Now, the following year, if neither one of them builds capacity, the highest they can get is about 75%. And that's with their production that's with their market share at this level. If they grow in market share, again, they're not going to be able to do this. Now, we're dropping market share. I showed you guys that earlier. We are raising our prices, which is going to cause some people to go elsewhere. And we are dropping our advertising, which is going to cause some people to go elsewhere. I mean, we're not bringing in as much market because we're not advertising, so we're not getting as many new customers. And then our existing customers, when they see that our prices have increased, some of them are going to look for substitutes and alternatives. It just is what it is. So because of that, we're forecasting that we're going to lose market share, and someone has to pick that up. So these other companies, when they're hopefully we're not going to stock out, but they're going to have to pick up the market share somewhere. There's going to be extra demand, and once they start seeing that, it's also going to change their allocation for where their shoes are going to go next year, so that'll leave more open in the private label segment. Our goal is really, if we can just lock down some profits per shoe, that would be fantastic. So it really comes down to who builds capacity. But we didn't want to allow the BZs or Cart Company to build capacity this year and then dictate to us what was going to happen. We wanted to be able to dictate the market. We figured that's the best way to stay in the league going into year 20. So I don't know if that is the right way to run it, but like I said, we're kind of in it to win it. We didn't want to leave it up to chance. Now, they could pull anything this year. They could drop their prices like they did last year. BZs dropped their prices last year. So they could drop their prices. That could throw things off. They could raise their prices. That could throw things off. Cart Company could drop their prices. That could throw things off. There's a lot of different factors that could happen this year, but they all kind of had to happen in the branded segment, internet and wholesale. The private label is pretty much what it is. We're going to go in and we're going to underbid in North America. We're going to bid high everywhere else and see what happens. It's not really going to make or break us either way, but that's the strategy. That's where we're going. And we'll tune in next time for the results. We'll show you what happens.